Is the tremendous retail trader engagement that we are seeing right now, is it sustainable? What does this mean for all these platforms? Our next guest says we may never go back to pre-2020 levels. Piper Sandler's Rich Repetto joins us now to give us a read on what this means, not only for retail investors, but for the exchanges they trade on. Rich, it's always great to get your thoughts. When you say that the volumes are here to stay, it's because we live in a zero commission world?
Yeah, certainly. You've seen trading just multiples of what it was, prior to when you had paid commissions. So the zero commissions, the state, work from home environment, as well as, we've had a performing market as well. I do want to take a moment. I've been listening to the show, and I do want to say a couple things about the e-brokers, which I, have followed for a number of years. If they can do another trade for a customer, they will absolutely do it. So I think one of the discussion points was, are these retail brokers trying to save the customers from themselves? I don't think that's it whatsoever. If they can do another trade, they're going to get paid for another trade in payment for order flow. They want to see more trading. I've talked to both Robinhood, Interactive Brokers. It is the risk management side. It is coming literally from other places as well, from the clearinghouses. But you can see when you put enough stress on the system that, you can have some not so good things happen like we did with, Lehman Brothers. Mm-hmm. So when Thomas Petterfy looks at the system, and he was on your network today, and he talked about the integrity of the clearing system, he's concerned that, these movements have been, dramatic. I think everybody on the show will, acknowledge that. So when you have dramatic movements like that, they definitely stress the capital, the deposit requirements. That's what's being passed on, to the brokers. And just like Dan said, the brokers do have a fiduciary requirement, or to their investors. It's their capital, and it's this capital that's under dramatic stress. When you see movements like this, and no one would have predicted that some of these stocks can move the way they have, and you'd have such a mass movement. We traded 24 billion shares yesterday in the market. We normally trade, this year we trade about 14. In 2019, we only traded 7 billion shares. Mm-hmm. So that's what these brokers have taken on, literally multiples of the volumes, that we did, a couple of years ago.
So, Rich, can you just sort of simplify this for, people like me? The options expiration on Friday. I mean, what role does that all have in the decision today to restrict trading?
It's the capital requirements, mm-hmm. at least with one of the brokers that I talked to about, that the clearinghouses now are requiring so much capital, for these positions as they take, it's a two-day settlement, so much capital that it's straining the amount of capital that they have overall, as a firm, that it's putting at risk. And you saw, if a brokerage firm doesn't have capital, we've seen what can happen, and the follow-on effects of it, the loss of confidence in who will lend you money and who won't. And you've seen at least, they're all restricting the trading now, is what I'm told. But certainly a very knowledgeable, guy of the clearing system, Thomas Petterfy, got on the network today and said, hey, this is challenging the system. He's overcapitalized, so he's not worried about his capital, but he's worried about the integrity of the entire system, mm-hmm. when you put that much stress on it.
Rich, in a zero commission world, hi, Rich. In a zero commission world, these folks are not making money, obviously, on trading commissions, so they're making money somehow. So I guess my question is, maybe they're answering to somebody else, and maybe that's where we should be focused on, really, why things played out the way they did today. I know that puts you on the spot a bit, but that to me is the crux of this entire thing.
No, I agree with that. I agree. First, they make their money on payment for order flow, so they are still getting paid, not what they used to get paid for the trades, but they are getting payment for order flow. So there's a total incentive for them to do the extra trade, especially in these stocks that are trading, enormously right now. Where I think, as we look into this and re-examine, this will be re-examined because there is a lot of pressure, as you talked about, the marketing impacts and the brand impacts this is having, but it'll be investigated. And at least what I'm being told is that the capital requirements that are being passed on from the clearinghouses are limiting what they can do. And, it's making things risky enough where they don't want to take on more trades because it risks their capital. And then once you get into you understand, I think we all understand, you get into a situation where your capital is the confidence in the capital,
Right.
it can be a spiraling effect.
All right. Rich, thank you so much for your time. Rich
Good to be
Repetto
with you.
of Piper Sandler. Dan, Nathan, you nailed it in terms of the clearinghouse angle and the risks to the system here. The perception, though, is the perception, and perception may not be reality in this case, or it may be reality. We're not 100% sure, but the perception is that they shut us down, and that's not easy.
Yeah, no, it's not. I mean, listen, any customer has the right to be upset about the service that's provided to them, and especially when it comes to your money. I mean, I think that's a major point. I think some of the changes that are going to come, I think before we even see further regulation, and no one knows what it's right. I agree with what Tim said before, who the arbiters of this sort of thing, but these companies have these fiduciary responsibilities. It'd be a lot worse if Robinhood went under. Do you guys remember the palpitations in the market when MF Global went under and all the counterparty risk all over the street, all over the world for that matter? It's big stuff, okay? So no one wants that to happen. And, we use this expression every once in a while, and I don't think it's used properly, that whole black swan event. Well, wouldn't it be perfect at the height of all-time, with the markets, with interest rates at all-time lows, with deficits where they are, with everything in the general euphoria about risk assets, that a black swan came along, right, and just blew up the whole thing, Yeah. I mean, people were calling the global financial crisis for years, but this is the sort of thing that you want to tamp down pretty quickly, I suspect.
James, what do you do if you're a shareholder of American Airlines? American Airlines is not a GameStop. It's not a Build-A-Bear or Koss Corporation. I mean, it's American Airlines, and that was put on the restricted list as well today. This is sort of a rolling, heavily shorted stock list, it seems.
Yeah, they're going to look for, they being traders, they're going to look for opportunity wherever there's a trade, and nowhere's safe if there's an equity that can be influenced and traders want to take advantage of it. It's just human nature of greed, and that's what's going to happen. And I think ultimately, as I said earlier, regulators are watching, they're studying this very closely. In this ecosystem of free enterprise, we have protection. We have protection from independent government officials who are watching. They're very smart. It's a very, 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 very quickly changing situation. It's complicated. There are rights on both sides of the investors who are seeking profits, and then those investors who may hold the positions and get hurt. Ultimately, they'll come down with the right decision. It's just timing-wise. We'll see this thing come to end pretty soon, and we'll be talking about something else.
Shepard Smith here. Thanks for watching CNBC on YouTube.